4, 3, 2, 1.
All right.
Are we finally back in the studio?
Finally back in the studio. It's been 3 weeks. And we're back here with a new
setup?
New table. Connor's been working since I've been on the road.
Not that much. Except I broke my iMac.
You broke shit. I got shit stolen. I mean, it's...
Jerry comes into the office, which you guys can't see on the other side of this. We have desks, and the whole front of my iMac is laying down. He calls me. He's like, man, what are you doing, surgery over there? I was like, nah, it's not supposed to look like that.
Yeah, it was the first time I'd ever seen the middle of an iMac. I can tell you that. It's kind of cool.
It looks like a robot machine, doesn't it?
Yeah, it does.
All right, man, what you got for us this week?
Well, it is the end of November. We have one trading day left in the month, which is Monday. So it's not quite like I can't put up a pip or anything because we don't have that yet. But we're pretty much done with the month. So yeah, that's going to fit into one of the charts we got coming up.
I was done with this month on the first of the month.
Yeah,
this whole month has been crazy.
This whole year, bro. Crazy. Okay, so the quote this week is from Robert Kiyosaki. If you guys don't know him, I would highly recommend checking out his book series. It started off with a book called Rich Dad, Poor Dad. And then he made a whole series out of that and made board games and the whole thing. It's really, really good. The board game is great, and they have one for kids too. It's great. It definitely teaches you basically the basics of finance and budgeting and all that kind of stuff, and how your choice of career and how much you make and how much you spend. Sometimes people that make the most don't necessarily have the most to invest. It's a little bit counterintuitive, but
I think a lot of people in the government can relate to that.
Yes.
Because, by and large, obviously I think, law enforcement and some other ones probably benefit from this more than others because we kind of come in at a higher GS scale or whatever. But I mean, we know a lot of people that make well over six figures in the government, and then, but we
Spend
don't.
it.
Yeah, we just keep growing the lifestyle
Right.
rather than building wealth, which is hopefully what we're going to spend the next 10 years.
Yes.
Convince people it's a bad idea.
It is. Yeah, it's a bad idea.
Skip the boat. Skip the boat.
Yeah. Well,
buy the boat later.
Buy the boat later. Yeah, you got to have the boat at some point. All right. So anyway, financial freedom is a mental, emotional, and educational process, and I think this is definitely something that we can all relate to as far as TSP goes. It can certainly give you financial freedom. It is definitely a mental process. It takes some time. Like we always say, it's a marathon. It's not a sprint. And it's an educational process, which is the point of this website and the podcast and everything. It's an educational tool for you guys. But the biggest thing that I think everybody would appreciate, it's an emotional process. You can know how to use all the tools in technical analysis, but if you can't emotionally look at it when the tools trigger and make the reallocation, if you give it another day on the wrong day, you lose out, big time. So that's one of the beauties of technical analysis, is taking the emotion out of how you trade. So I thought that was a pretty good quote for the day. Okay. So this week on the market, obviously it was a shortened week for the Thanksgiving holiday. It was also shortened because Friday the markets closed at 1 o'clock. So you had Thursday, the markets were closed. Friday, they closed at 1 o'clock, so we got an unusually low volume. So when you see it on the chart this week, that's why. We didn't have 5 full days of trading, so obviously the number of shares that traded for the week was much less than a normal week. Having said that, all 3 TSP stock funds were up quite a bit. Last week we had a consolidation down to the 10-day moving average on the C fund. But then this week, C fund exploded back up, closed at new all-time highs. The S fund is doing way better than the C fund. And the I fund actually is doing the worst, but that was up just under 2% for the week. So a really, really good week for the stock funds. So what we're going to get into first before the daily, the regular daily, 1-year daily charts, we're going to get a bigger perspective of exactly where we are in terms of the megaphone pattern that we've been talking about. And then we're going to look at comparisons. We're going to compare the funds to each other. So a lot of times people ask, should I be in the CNS fund or just the I fund or just the C fund or whatever. So not so much talking about reallocating between the G and the stock funds, but more reallocating between the stock funds. That when is one doing better than the other?
Right.
And so I have a comparison chart that we'll look at, and one of the good ways to see it, because this is all visual, it's all the charts and the patterns and stuff, right? So ratios, if you compare the S fund to the C fund, the I fund to the C fund, you can see in the chart clearly which one is moving higher versus the C fund, right? Okay. I can't believe you haven't poked in with some comments yet.
I'm too busy switching cameras. I'm trying to be producer today.
Good. You have one job, Conan, one job. All right. So a little bit, this is a 4-year, so a little bit wider perspective, 4-year daily chart of the S&P 500 C fund. So we've been talking about this megaphone pattern for a while, and I'm going to zoom in here in a minute, but what we're really...
That darn pen.
Seriously. Pen. All right. What we're really looking at is this part right here. So on a 4-year chart, it doesn't look like very much. It's this part right here. But from the top of that to the bottom of that is 11% move. So it's quite a bit. It's pretty important. So we're going to drill down into it. Okay. So the blue line is what we've been using to signify the top of this megaphone pattern. It's not an exact science, that they don't line up exactly. So depending on how you draw the line, it could be the blue line, it could be the dotted black line. If the blue line turns out to be the one that's correct, then we're above it, which is great. And we should get support there at 3,600 and we keep moving higher. If it's the black dotted line, then maybe we're hitting resistance there and it rolls down. So what I'm saying is, I know, because I get this all the time in email and messaging, we've hit this 3,600 level. Does that mean we're free and we're out?
Right.
I mean, no. We're not out of it enough to be guaranteed to be out of it.
Right. And if we were way above that dotted line, like just a huge bump up, that's way more of a signal technically than what we're looking at right there on that chart, right?
Yeah, because it's a 4-year chart. So to get out of the pattern on a 4-year chart,
you got to have a big move.
Yeah, you got to have a big move.
Yeah.
And if you get a big move like that without a pullback, well, if you get a big move like that, like if we popped up to 37.50, let's say, we would definitely be out of the pattern.
Yeah, we're out of the pattern.
But we'd also be getting some kind of retest of that line. So
right, because the angle of that line is not exact.
Yeah, definitely not.
Yeah, because you can draw these lines. You have to draw these lines, but you also have to, you have to realize that the theory behind it is that line exists, and we're trying to figure out where it's at.
Right.
Because the chart doesn't give you the line. You add the line.
Right.
Right. And so you're being as precise as you can, but unless there's this major up or down to get away from that line, right, then that's when you break the megaphone for real.
Right. Right. I mean, the megaphone is just you have higher highs and lower lows, right? So often you can draw lines to connect the highs and connect the lows, and you can see the megaphone pattern. Sometimes, like, turn on the pen. Like this, why is it doing that? This piece.
Yeah.
Right? This high was higher than this high. This low was lower than that low.
That's what kind of started it.
Yeah, it started. But as soon as we, let's see. This high is so much higher, that if you drew the, I can't really do this without a, you know what I mean? If you connected those tops, it doesn't So the rule is that higher highs and lower lower lows.
Yeah, that second higher high that you drew the dotted line isn't that much higher, but it is higher. And
Right.
so that's why the trajectory, right, the angle
Exactly right.
could be a little skewed, and that's what you're looking out for, right? That's why now there's two lines.
Yes.
Right, because it's not an exact science, but it's pretty close.
Yeah.
And that's why those lines are pretty close.
That's exactly right. Now, it matters because if the dotted black line turns out to be the one that's correct, then we're bumping up against resistance on that line.
And we're still not out.
And we're not out. If it turns out that the blue line is the correct one, then we're probably, consolidating support on that line, and we go higher.
Yep.
So
yeah, and hopefully we'll be able to see that within December.
I expect so, and we're going to get to that actually on the next chart.
Because the volume, even though we have another holiday coming up, there should be enough volume to show and enough movement to show.
Yeah, I'm actually I'm really looking forward to what the market does in December. I'm really looking forward to seeing what happened on Black Friday.
Yep.
And
Cyber Monday
Cyber
that's
Monday's gonna
coming.
be huge. Yeah.
And I just to be transparent, when I wrote my letter to Santa Claus,
yeah,
I asked him for us to be out of the megaphone.
Oh, dude.
So I think we're in.
We're in good shape.
Yeah.
Okay, good. Okay, so on a daily basis, we're looking at this 4-year chart and we're going, okay, not really sure that we're out of the pattern yet, but we understand it makes sense when we look at it. So the next perspective is the same chart, but instead of daily, it's monthly. Okay. So here's the thing. You each one of these ticks now is a month, and so that's why like this month, the volume is still a little bit low. We have one more trading day in the month, and we have the holiday, so volume might be a little bit higher than October, but it's not going to be all that high. But here's the thing that I thought was interesting when I was looking at this. The more perspectives you can get, the better, the more data you have to make reallocation decisions. So this is pattern recognition, right? This is visual. So I'm looking at 2018. We have this nice run up here and 2 months of consolidation. Run up here, 2 months of consolidation. Run up here, 2 months of consolidation. Run up here, 2 months of consolidation. So if the pattern continues, we go higher from here.
Run up there,
More
consolidation.
Right. If the pattern continues, we go higher. It's different because we had this run up, we had a high, 2 month consolidation, run up, 2 month consolidation, but then we had a lower low, right? Then we have a run up, 2 month consolidation, lower low, lower than this one.
Yep.
Run up, 2 month consolidation, nowhere near a lower low.
Right. And now we're kind of waiting to see how that plays out.
I mean, this is a big change in the trend, right? Because the megaphone pattern had been created because this high is higher than this one, this low is lower than that one, and it followed the same 2 month consolidation. This high is higher than this one, this low is lower than that one, right? But now this is different. We got a 2 month consolidation, but it's theoretically it would be a month here, and it would have been lower than that one if it had played out.
Right.
But it didn't do that. We had a 2 month consolidation.
But it's not a big enough move up that we couldn't consider that maybe it turned into a 3 month consolidation.
It's all kinds of, anything's possible. All I'm saying is if the pattern continues, well, the pattern didn't continue. We had a 2 month consolidation and it did not bring us to lower lows. And we had a huge breakout higher in November.
Yeah, that's a good signal.
Yeah, it's kind of like this. Right? It's not quite as big as this one, but it's definitely a big move off of a consolidation. So if I'm looking at just this monthly, 4-year monthly chart, I am very happy to be in the stock funds right now. I mean, it looks like this is the pattern, and we're out of it.
Now I know I'm going to throw like a wrench in this,
Okay.
but that's what I'm here for. Not really a wrench, but like, you know, I see this coming up a lot where so this is the S&P 500.
Yes.
C fund. Tesla's getting ready to join the S&P 500.
They have joined, yes.
It's already in.
Yep.
Yeah, sorry. I'm been asleep for a week. So, right, there's all this chatter about, well, you added this really kind of, I don't want to say volatile, but you know, you've added this stock, this company to the S&P 500 that is first I have a question, is it exactly 500? Because then if they added one, did you take one out?
Yes.
Yeah, exactly. So if you replace these two, all right, you swapped them out, what kind of impact does that have, knowing that, like, you know, we were talking about it yesterday where, you know, you called and said, hey, Tesla will be 500 before the end of the month, and it turned out before the end of the week. Right. It's going to be, so I guess where I'm going with this is like how much of an impact a change like that with a company like that is kind of doing, you know, these kind of big moves is going to impact. I guess the real question here is like, how does one company impact, you know, out of 500? Is it going to be an impact, or are we just, or does it just absorb it?
It doesn't matter too much
out?
to us.
Yeah.
It doesn't really matter that much to us. It's pretty complicated, and I really can't explain it how it actually technically integrates into it. All these indexes are weighted. It's not like an even.
Right. It's not an even distribution among those companies.
Right.
Yeah, and the reason I bring it up is because I know that certain folks out there are thinking about this.
Yes, definitely.
Right, and thinking like, so if you're just, and this goes back to the difference between why, you know, we're forced to deal with indexes because that's the TSP.
Right.
But even if we weren't in the TSP, we would likely just be dealing with the indexes. And if you follow people that have been doing this for many years and are billionaires, and, you know, Warren Buffett, those kind of guys, they're like, hey, S&P 500, like, don't mess around with Apple versus Tesla, or that's the wrong game, right? The index is the right game to build wealth, right, for long term. And so I point that out to say that, like, it kind of goes back to the whole thing of like the market doesn't really care what your personal circumstances are, right? The market's the market; it's doing what it's doing. Right. Does it really care that this new, you know, hot company comes in the S&P 500? Probably not.
For our purposes, not a lot.
Right.
I mean, I mean, there's a lot of Apple and Amazon. I mean, I don't want to talk about it because I don't.
Yeah.
I'm not sure because a lot of it's on the Nasdaq and the S&P, and so
it's why we look at multiple indexes. But I just wanted to point it out. You don't have to give like a technical.
Yeah, I can't answer the question without looking at.
Because I didn't give you a chance to study up for it.
No, that's okay.
I caught you off guard. But it's something we could think about. You know, maybe looking forward, because I do know I've seen posts and people talking about like, oh, you know, when this happens, it's going to go off the charts, and I'm like, 1 out of 500.
Yeah,
I don't know about that. Like, it won't be Tesla driving the train. It will be tech, maybe, which means Tesla's in there. As far as
definitely.
tech, right? That's what will drive it, right? This huge section of the S&P 500.
Yes,
right.
Definitely. Yes, and remind me about that as we get later into the charts, because
this is why the shows get longer than they're planned. That's because I take Jerry off
down a rabbit hole. That yeah.
Next slide.
All right, next slide. So that was a 4-year daily perspective and a 4-year monthly perspective. So how do we compare the funds to each other? All right. This is a 5-year comparison of the CS&I funds to each other. So ordinarily I use stockcharts.com. I have a subscription to that, and I'm putting up charts that I'm pulling charts off there, and I'm writing on them and then putting them up in this presentation. So it's hard for you guys to create the same charts that I'm doing, but this particular chart, it's called bigcharts.com. Okay, Big Charts, you don't need a subscription to. It's much simpler to use than stock charts, and maybe we'll do something about that next week or the week after, just to kind of walk people through how to use it. But it's much more simple, which means there are less tools. But this is one of the best tools on there. You compare. So I'm comparing the C, S, and I. So the C fund is the S&P 500. It's the black line. The S fund is the yellow orange line, and the I fund is the blue line. Okay, so the way you compare it is you start at the same point, and so that's why it's on a percentage basis compared to each other, because we're starting at the same point right here 5 years ago, right? So the chart is of the price, but it's a comparison to each other. Okay. So on whatever it was, November 27th, more or less, back here was the 0 point. Okay. At some point, so here's the first thing. We always talk about, ordinarily, we are evenly distributed between the three stock funds when the market's going up, and in the G fund when the market's going down. And so just by looking at this chart, you can see that overall, in general, when one stock fund is going up, they're all going up, right? That the lines kind of go together. And on any given day, especially here with the C and the S fund, they overlap. You can't really tell which one's going to be higher or lower on any given day. The I fund clearly has been underperforming over the last 5 years. Okay, so in hindsight, that's great. You can see what happened. It would be much more valuable if you could do it sort of real time. So you could say, okay, I don't want to be evenly distributed between the stock funds. I want to be all C because C is crushing the S and the I, or I want to be in the S and the I because the C is lagging or whatever. So here's how you would kind of look at it in hindsight. Okay. That's a comparison chart. The ratio charts really tell you, actually, let me go back. Let me do one more thing real quick. This area right here. Okay. Right now we got, in 2016 and 17, there's not enough of a deviation between the C and the S and the I, because they're pretty much moving up together. But in this area right here, okay, you got the C fund, C and the S that break out right there. And you get the I that breaks down at the same time. It's a divergence. Okay? So if you could see that on a daily kind of basis, you would definitely, that's a time that you would be like, all right, I is going down, C and S are going up, I'm definitely getting out of the I. It doesn't happen very often, as you can see on the chart, but when you see that, it also means that the I was leading, because yes, the price continued higher, but then it came down, and at this point, they're both hitting a bottom. So if you don't follow this really closely, the one of the best ways to diversify within the stock funds is to just evenly distribute between the stock funds when the market as a whole is moving higher. So,
but also remembering to get out when it isn't.
Oh yeah,
that's the key.
I mean,
because the other wisdom is to just let it ride. So
yeah.
I always make sure to point that out, because we have a lot of new people that jump in and that are in
Right.
the Facebook group and members.
Right.
And so the idea is as Jerry just said, that as it's traveling up, generally speaking, you could just be evenly distributed between three of them. If you want to do that, if you want to play a little more risky, you go a little heavy in one versus the other.
Right.
And then, but you got to remember that as it starts to trend down, you want to be in the G fund. So you
Right.
keep that.
Right. G fund is the only place to be at that point, and you can kind of see it right here. They all went down.
Definitely see it.
I mean, they all went down together.
Right. And back there in 19, I mean, still pretty much together.
Yes. Yeah, pretty much together. I mean, let's see if I can zoom in. The I fund, you see I can't do the pen and the zoom at the same time, but.
You could zoom out, draw it, and then zoom back in.
Yeah, let me just do that. On the I fund here, we had this high, right? Then that high was lower. Can you see that?
Mm-hmm.
On the C and the S, you have this high, and then the top high was higher. So there was a divergence there. And what that means is the I fund is telling you, the I fund rolled over first. The I fund led the market down. So if you were watching the I fund, and you saw the weakness there, and you use that as your indicator to get out, you would have gotten out even sooner than we did. And we got out right there. The day, I think it was the day before the actual top in February.
Yep, and that's mostly because we're waiting to see what it does. If you are a little riskier and you're following the eye and you see that it's leading, and it also led, if you go back to 18, then you know, hey, again, it's an indicator.
Right.
If you want to be risky, jump out. If you want to play it out a little bit,
right, let it ride for a minute.
Yeah, and just see where it's going for sure. That's the difference. That's the difference between being high risk versus low risk.
Right.
Same technical analysis.
Yes. Same analysis, and you just apply it to your personal risk tolerance. I mean, I don't have the chart up, but if you remember back in February, there was a lot of talk about coronavirus, but it wasn't a pandemic yet, and the U.S. wasn't involved in it. And when we put out that alert to get out of the stock funds, it was because the price. Well, it was the end of the month.
Lost our logo.
Uh-oh. It was the end of the month, and so I was trying to conserve the reallocations for the next month. But the biggest and as I'm looking at that, thinking like technically how to work through these 2 moves a month kind of thing, we were really high above the 10-day moving average. So I wanted to lock in some gains is what I was really doing. I mean, obviously I had no idea that the 2 days later the market was going to tank for the biggest correction, in the last 5 years.
Because you don't have a crystal ball.
Because I don't have a crystal ball, and but I was responding to a lot of things. In that case, it wasn't just the market; it was also the TSP rules and how far we were extended above the 10-day moving average and all that kind of stuff. So, I've had people say, "How did you know?" I'm like, "How did I know what?" Like, I didn't know anything. It didn't happen. I didn't know.
Right.
I just can only respond to what the market's doing at the time.
Yeah. It's not that you know, and this is for, I think, any analyst really that's honest, right? It's not that you know what the market is about to do. There are indicators that tell you what it may do. And as the probability increases, because there's multiple indicators, as there are multiple indicators, the risk level is lower to make that change. Whereas if you really want to go high risk, you don't wait for as many indicators, right? So we were always kind of preaching, like, that's why we might wait a day, we might wait 2 days. We're looking for more indicators that lessens the risk, and the probability is higher. When the probability is higher, the risk level is lower normally.
Right.
If the probability is weaker, right? If it's lower, that's probably high risk. Doesn't mean that you're not going to make a correct decision. And I say not you, Jerry, but like you, the investor. And so that's what, we're going to always harp on this, because that is what you as an investor out there listening to us have to decide. And it could change over time. We talk about this, right? Early on in my career versus late in my career. And it doesn't even matter how long I've been. Maybe early on in my career, I'm married and all the, I just bought later on in my career, I'm not, right? Maybe I got a divorce. Maybe I've got less, whatever the scenario is, it's not, everybody's is different, which is exactly why when people email us or message us and we're like, we can't give you that kind of advice because we don't know your circumstances, and that's not the business we're in. We're trying to get you trained up so that you know your circumstances, these indicators, this way to do analysis, that you can go, hey, I can afford to be a little risky. Right? I see the indicator, probability is kind of low, but I'm going to risk it. Or, or
hey, I'm getting ready to go on vacation and I'm not going to be watching the market for a while, so I'm out.
Bingo.
Right?
I'm putting it in G. Going to sleep well at night.
Exactly.
Good. Or you could just say, no, I'm going to let it ride while I'm on vacation because I'm okay with it.
Yep, you can do that too.
It's your circumstances that drive that, and we can't figure that part out. What we can do is educate you on on that indicators.
Right. That we talked about it, or I guess I did because I was on my own for the last 2 weeks. I'm pretty sure
I was there in spirit.
In spirit, I know. The last alert that we did the day after the election, right? Then the market ran up for like a week, and people were like, "Hey, I missed the alert, or I didn't get in, whatever. What should I do now?" And at that point, the price was really extended above the 10-day moving average, and so the risk is high, right?
That it's going to come down.
Yeah, because if it comes down, then the support, the place where our line in the sand would be, which is a close below the 10-day moving average. If the price now is 10% above the 10-day moving average, then you're gonna absorb a 10% loss before you even decide whether or not to get out, because the 10-day moving average is your base, right?
Yeah.
So if you're not comfortable with that level of loss before you make a decision, then you shouldn't get in, right? Now, having said that, so what happened, right? The market, there's only three things it can do. It goes up, down, or sideways, right? So if it had continued higher, you'd be kicking yourself saying, I should have gotten in. If it rolled over and went lower, you'd say, okay, I'm glad I didn't get in. Or, I'm glad I didn't get in. If it goes sideways, which is what it did do last week, it went sideways all week and allowed the 10-day moving average to catch up to the price. And so that's really the most important thing, because if the 10-day catches up to the price, now there's support there. And every day that the 10-day comes up to the price, your risk is decreasing by that amount every day.
Right.
So, and then we can see, I think we talked about it last week, but we got a pop off that 10-day moving average. Oh, that was a little midweek thing I put out. It popped off that 10-day moving average and it's going higher. I mean, these tools, again, it's as much art as science, but it definitely works. Okay. So ratios. So you see the comparisons. This is what it looks like if you wanted a chart of the three stock funds compared to each other. But if you really want to be able to trade it, this is the 5-year of the ratio between the I fund and the C fund. Okay. So the I fund is in the numerator of the ratio. And this is going to get a little 8th grade math. But the I fund is in the numerator and the C fund is in the denominator. So what that means is if the I fund is greater than the C fund, if the numerator is greater than the denominator, the angle of the chart is up. If the I fund is less and decreases versus the C fund, the angle comes down. So this is the I fund versus the C fund. So by looking at it, you can tell, you don't need the 8th grade math. You can tell that the I fund is decreasing versus the C fund, right? It makes sense. And it's just like this because the I fund over the whole comparison was lower. Okay. So if you wanted to look at it, you could say, okay, I see some support here. Possibly a double bottom here. You got this bottom, so you get this and this and this. I mean, once it broke down here, that was what, middle of 2018. So that was that we were talking about, right? So you can see it. It's it definitely works. So the I fund over the last 5 years has definitely been lagging the C fund. Now, if it turns out that this ends up being a double bottom, then if the chart continued down, at some point it'll go higher. And that would be the time that you would want to get into the I fund and out of the C fund. Okay, the S versus the C. Just like back here, the S and the C pretty much run together, right? And it's a little bit, S gets a little bit higher here, gets a little bit lower there, and right now we're pretty much back to being even again, right? This is pretty much it's pretty much even, right? And then the S fund actually corrected much worse than the C fund on that crash.
Yeah, I think it's important that when you just showed how that was generally flat all the way across there, that I think a lot of times people try to get too micro.
Yeah.
And they're looking at that going, that's not flat, right? And it is. That's why we do micro and macro charts, just so you can pull back, and you got to be able to look at that chart and go, yeah, it's generally flat, right? Yeah. Not worrying about that big spike there in 18 and no, generally flat. There, when you go past 20, that's not flat, right?
Right.
Yeah. So I just pointed that out because you've taught me that really of being able to pull back and get that macro view, and go, oh, okay, well, that's generally not as volatile as it looks. If you're zoomed in on one part of a year, which was, if you watch Bloomberg or CSNBC, they're always seem to be zoomed in on today, right? Barely talking about the week or the month, never about the year, not never, but yeah. So if you get sucked into that, you're always looking at this micro view, which is very volatile.
Right. And it doesn't help us because you get 2 trades a month, and you have to have your trade in by noon to get the closing price.
We can't do microanalysis because we're not day trading.
Yeah, you can't. I mean, it's hard because, exactly like you said, if you are walking by in the office and you look up at the ticker on the TV or you listen to CNBC or whatever, 80% at least of their time frame that they're talking about in those shows doesn't apply to us.
Right. It's hourly.
Yeah, I mean, we can't. If you get sucked into that, it does. It really messes up the way you think about TSP. I mean, I cannot tell you. I mean, the comments and stuff on Facebook and email that are like, "Hey, the market was up today. What should I do?" Or the market was down today. I'm like, I mean, there's nothing you can do with that. You know?
That's not the game we're playing.
You have to do it based on the patterns, and you have to give the pattern some breathing room.
Yeah. I would say that, when we've talked about this, if you're not in the TSP, or let's say you're in something else. So you have the TSP, maybe you have another IRA, or you're out of the TSP in your IRA, whatever. Let's just say you're in a different vehicle, investment vehicle. Then it potentially could, you can use this exact same analysis if you drill down to intraday and day. This works for day trading. It's not to say that it doesn't work. Right. It's just that we're forced to not use that because we're 2 moves a month and all the rules, right? If you're not dealing with those rules, if your spouse is in a 401k, you can use the same educational tools we're giving you. You could take those, move them over, work with your spouse's funds and their 401k and do this exact same thing. It works no matter where you're at. It's just that we're layering it over the TSP because that's what we have to do. Right. So I just want to point that out that I think a lot of times, people just get focused in there, and there's other ways to play this game. There's other ways to play our game.
Yes.
Other places,
other platforms, other places to play,
other
definitely.
vehicles, what have you.
It's harder for us than most people because most don't have these restrictions.
Way harder. Yeah. Once you get over into an IRA, that you have the flexibility, and now the fees are so low. Yeah. You can use these tools to do a lot of wealth building.
Yeah, definitely. Okay, so that is the ratios. So hopefully, if you guys have questions about that, just email us or comment on Facebook or whatever. But definitely take a look at bigcharts.com and do the comparison chart. The ratio is a little bit trickier, but if you get into stockcharts.com, you can figure that out as well. Okay, so we'll just go through the CSNI, the 1-year daily charts, and like we always do, we got the 10-day moving average, the 50-day moving average, and the 200-day moving average. So right now, let's see. We were talking about how actually, let me go back and draw it. That was the top of the move that that came after the election. So we got in on that day right there. And that was the middle of this run up off the bottom there at the end of October. Okay, so over the past, from that top, where that top arrow is pointing down, we've consolidated, right? And we allowed the 10-day moving average, the green line, to catch up. But you can see that the 10-day moving average crossed up through the blue line when the price was up here where this top arrow is. So at that point, the difference between the price and the 10-day moving average was like 8 or 10%. I mean, it was high, right? But what happened, rather than the market rolling over, wow. Okay. The price was here. If the market had rolled over, that was about an 11 or 12% move down to the 50-day moving average. That nobody wants that. Even down just back here to the 10-day. All right, I can't do it. Even back here down to the 10-day, it was way more than what I was willing to absorb. But what happened is the market went sideways. Right? That consolidation allowed the green line, the 10-day moving average line, to catch up. And so it caught up, hit that 10-day moving average line, and exploded higher on Tuesday. Right? So could it roll over from here? Sure. But that's a really good example of support at the 10-day moving average. Okay. I'm going back to Apple, I swear. Microsoft stuff is killing me.
The pen's giving Jerry a hard time today, folks.
Okay. So right now we're a percent or two above the 10-day moving average. That's fine. If it comes back down to the 10-day, no problem. Nobody wants to absorb that loss down to the 50-day, and definitely not down to the 200. So the C fund is looking good. S fund is way extended, right? You can see how far the price is right now above the 10-day moving average, and it's way extended above the 50 and the 200-day moving average. And the indicators are pretty well topped out. So if you were risk averse, you could consider moving some of that allocation that you have in the S fund to maybe the C fund, because it's just beginning a breakout. Or you could let it ride or whatever. I mean, I would not be surprised to see the S fund pull back over the next week or two. It's pretty far extended. But again, it could go sideways and give time for the 10-day moving average to catch up, get some support there, and keep on moving higher. And since we only get 2 moves a month, I don't know that I would mess with it just yet. But it's something. It's not really an indicator, but it's definitely something to be aware of, right? It's extended. So if the S fund rolls over a little bit next week, you should not be surprised. That's all. And the I fund, same kind of thing almost as the C fund. Had a huge move up off the low at the end of October and consolidated last week, and then Tuesday jumped higher. So I fund looks really good. If you did a comparison instead of a 5-year comparison, if you compared, well, we can look at it this way. This is weekly, and here's where we are right now. Right, we're at the sort of the top of that channel line. I mean, if the I fund does really well compared to the C fund next week, and we get, up here somewhere, then we're out of this channel, And chances are the I fund is going to, would be doing better versus the C fund. And then that would be a good indication to get into the I fund. S, I. Yeah, haven't said that though, because I just saw that. When the I fund gets above, that RSI level gets above 80, or is that 70? 70. It's a top. It can stay above 70, which got you right there, which was here, and the price can continue moving higher. So just because it gets above that upper channel line 70 on the RSI indicator, doesn't mean it's going to roll over. It doesn't mean we're going to have a significant top. But when you combine that, so this is the RSI indicator when it's above 70. When you combine that with the MACD, right, the black line, if it crosses down through the red line, and the histogram behind it, the blue one, gets below 0, that's when it'll be accompanied by the price going lower. And whether or not that price, if the price went lower and broke through the 10-day moving average, that's the bottom line to get out. But what I'm looking at in this case is, even though the RSI is staying flat, it's consolidating flat along that 70 line, the MACD is actually looks to be turning down. So I'm just watching it. Again, I fund, kind of like the S fund, I would not be surprised to see it roll over next week. And like I think I set up here in we're only 1.8% above the 10-day moving average, the green line, but we're about 8.3% actually above the 50-day, which is the blue line. So I wouldn't want to absorb that 8.3% loss if I was in the I fund. And also you got the top channel line that we kept talking about at 66, and that's also going to intersect basically with the 50-day moving average. So if the price did roll over and it came down, like to here somewhere, it would probably intersect that top channel line. It would get support there and support at the 50-day moving average. So if the price did roll over and come down there, I would be it would be healthy. It would be a good place to get back in. But to get there, you have to absorb an 8% loss, and I don't want to do that. So,
Nobody wants to do that.
No, heck no, nobody wants 8% loss. Okay, that's all I got.
I want more, Jerry. I want more.
It'd be cool if you could create things to happen on the market instead of just reporting the news. It would be cool if you could create the news, but
yeah.
Unfortunately, we don't make
this
things
isn't reality
happen.
TV.
No.
We're not making the market. We're just studying it. All right, guys, that's our show for this week.
I think that's it.
Yeah, if you got any questions for us, comments, keep the complaints. I don't really want this.
Yeah, I don't care about the complaints. I mean, we read them and we absorb them, but
how can you complain against anything that's free? Right? We're just giving this away.
Let us know how you like the new table.
Yeah, we like it. So it puts us a little closer
table.
and like facing.
Yeah, it's better.
These are little things that probably don't matter as much in the big picture, but we really are working hard. And we plan on doing this for years to come. And so we're working really hard at making this a good, valuable show for people to learn about this kind of idea of technical analysis and how to read the market. Again, if you learn these principles, you can apply them in all sorts of investment vehicles.
Absolutely.
Right? It's not just the TSP, it's just what we use, right? It's the TSP as the foundation.
You asked about Tesla coming into the S&P 500,
yeah.
right?
You going to give us a blue star pick or what?
No, I could have last week, actually. So I had one of my friends called and said, I bought Tesla like 325 or 350, something like that.
Yeah.
And it was up around 400 or 425, and he asked me if I thought he should sell. And I don't really follow Tesla that close. I don't own any of it, so I pulled up a chart. We're talking. I'm like, hold on. I pull up a chart, and I just did a real quick, 1, 2, 3, 4, 5 Elliott wave pattern, and I'm looking at it, and I'm like, oh no, absolutely don't sell that stock, right? I'm like, it's not only don't sell it, buy more of it, because by the end of the year, it's going to be over 500.
Yeah.
And I texted him back at the end of the week. I'm like, oh, dude, sorry, didn't mean to mess up your time horizon. It wasn't by the end of the year. It was by the end of the week. It hit like 501 within 5 days of when I told him not to sell.
Because the indicators were there. The probability was high, but you can't guess the time frame, right?
Right.
You just see that it's going to happen.
Right.
Yeah.
Right. The time frame is very tough, and in even the individual stocks, Elliott wave works best on indicators. All these things, all these technical analysis principles, in my opinion, work much better on broad-based indexes than they do on individual stocks.
Yeah, because stocks are way more volatile.
Right. But that pattern,
a single stock,
was
yeah.
That Tesla, that pattern, it was 1, 2, 3, 4, and I'm like, oh no, dude, you can't sell it here. It's gonna explode higher.
Yeah.
Like it's gonna be definitely 500 by the end of the year, and it was 500 by the end of the week.
We call that a teaching moment.
Yeah, it was teaching for me. I should have bought it.
All right, folks, enough about Tesla. Hope you guys have had a good holiday week, and hopefully we all have a great December, and we're moving in the right direction. Hope everybody's family is well. And on that note,
peace.
I think we're out of here.
Have a great weekend.
I got to find the right button to push.
There you go.
There we go. I didn't have the rock music at my fingertips.
It's the new setup.